express quantitative items, particular period of time. So that is called as a budget. So generally, this is a blueprint for the before doing. So generally, this is a blueprint for the before implementation of budget related matters. So according to the CIMA London, budget is a financial and quantitative statement prepared to period defined period of the time policy to be pursued during the period for the purpose of attaining the given objectives. So that is called as a budget. Budgetary control. Budget control is different, budget is different. So budget control is a systematic controlling of cost through the budget. It is applied for the systematic management accounting control by the all operations of output forecasted as per the ahead possible and actual result when known compared to the budget estimates. So this is the budget control. What is the need of this budget control? What is the objective of budget control? So generally this budget control will help to take the decision making purpose only we are going to use that. So every performance, decision making and essential to the performance of every managerial function. While making the decision, we are going to use this budget control. It is therefore necessary for the every manager to coordinate their interrelated aspect business activities that desire coordination through the what about the means of the budget. Being a plan's affection budget guides every manager in the decision making process. Budgeting is the lead the action of every manager, every level of achievement on organization goals or goals. Hence, this budgeting is need. What is the objectives of this budget? So budget control, budget objectives mainly planning purpose, coordination purpose, and control purpose. What is the meaning of planning? So budget is a plan for the policy to be pursued during the defined period. So what to do, how to do, how much amount will incur, and what is the steps to take the implementation of that items, that all are we are going to take. The budgetary control will force the management and all the level of plan time to time activities which is done during the future period. By the planning, many problems are anticipated long before they arise. The solution can be sought out through the careful study. So to meet the future problems, if you have proper plan and budget, present we can, when we ready for present, we can avoid the future problems also. Coordination. Second objective is coordination. The budgetary control coordinate the various activities of the firm sources. Cooperation from all the concerned that common objective of the various department. So if forces the executive to think as a group, effective planning and organization contribute the lot of achieving the coordination. And control. So third objective is what? Control. So control consists the action of necessary to ensure that performance of the organization conforms to the plans and objective. Control of the performance is possible with the predetermined standards which laid down by the budget. The budget control makes the control possible continuous comparison and actual performance. See, so simply I can say that control means what? If you know that how much you are spending, where you are spending, and if you know the previous budgets, based on that, for future also we are going to control. So if there are any wastage you identified, that also you can avoid it. So that is only control. Advantage of budget control. See, there are so many advantages are there. So budget control can enable to the management for the decentralize the responsibility without losing the control of the business. And budget compel the manager to think ahead, anticipate and prepare for the changing of condition. Budgeting is the coordinates with activities. Budget control ensure that capital employed of the participation level. It guide for the management. It is ensure that estimate the working capital, and budget control also maximize the profits and minimize the cost. So this is the advantages of budget control. What are the essentials request of the budget control? See, every business objective The business objective is very important. And the budget controls the system fully supported by the top level management. The budget output should be stated the clear terms. The variation should be reported clearly to the top level management. Budget committee should be set up their establishment of efficient execution plan to make the budget. So these are the essentials of budget. And organization for the budgetary control system. They need to follow some steps, that is organizational charts, budget committees, budget manuals, and budget period. It is the key factor. So budget charts means what? The charts show the authority and responsibilities of each executive of the firm. So this will be enable him to know his relationship with the other executives. So budget talks about organization chart talks about the relationship with the budget manager to the other persons. And budget committee. For the purpose of efficiency, budget control, budget centers are defined. A budget center may be department, a section undertaking. The budget control is the assist to the budget committee. So budget manual. Budget manual talks about the set out the responsibilities of persons engaged with the routine work. The budget manual lay down the objectives of the procedure and followed by the budget control. So budget period. So this budget is particularly we are going to prepare for some time, particular fixed time. What is the difference between budgeting and forecasting? So budgeting is different, forecasting is different. Budgeting is concerned with the planned event. Budgeting is a planned for the event. Forecasting is a mainly concerned with the probable event. And budgets are prepared the short period, but forecasting is long period. The process of budgeting starts with the forecast, ends with the converted into the budget. Whereas functions forecast starts with the, whereas functions of forecast ends with the forecast likes events only. So budget is prepared short period, whereas forecast is only tentative estimated, can be revised. And budget is compared with the whole business unit. Sectional budget can coordinate with the logical whole, whereas forecast covers limited functions only. And budget is made for respect of the spares which is relating to the business and industry, whereas forecast made several other spares which is not to be connected with the budget. Types of budget. So there are different types of budgets are there. That is master budget and fixed budget. So again, that fixed budget we classified into two categories, that is fixed budget and flexible budget. Let us talk about the master budget. What is the meaning of master budget? So master budget is the summary budget for the entire enterprises embodies summarize the figures of various activities. So it includes that all the overall plan of the business for the next period. The budget includes that budget position and profit losses as well as budget sheets. Master budget is prepared by the committee. It become a target for the company. Next one is the fixed and flexible budget. So fixed budget means what? Fixed budget is the one which is prepared the keeping the mind one level of output. It has been defined for the as a budget, which is designed for the remaining and unchanged. So when your master budget talks about it, we are going to prepare the entire summary of all the activities, but fixed budget is not like that. So for one particular level of fixed output, for that we are going to prepare the fixed budget. Flexible budget. So flexible budget, with the help of that fixed budget, when the level of output will change, the level of budgeting also going to be changed. According to change of that output and activities, the budgeting also going to be changed. So that is called as a flexible budget. Functional budget. See, functional budget, we classified different various types. So functional budgets include sales budget. Functional budget includes production budget. Functional budget includes that production cost budget, and functional budget also includes that labor budget, selling and distribution budget, administration. These all are different functions. Let us talk about the sales budget first. So functional budget, first one is the sales budget. Sales budget is talks about the estimation of sales, preparing of sales. So that is called as a sales budget. Sales budget is the most important budget of the primary importance. The sales budget is a statement of planned sales in terms of quantity and value. So how much we are going to produce, what is the number of quantity we are going to produce, so how it is required. It is forecast the company can reasonably expect the sales customers during the budget, the sales, how much they produced, what is the closing stock of sales, what is the opening stock of the sales. The sales budget can be prepared to show the sales classification according to the product, salesman, customers, territories. So this all we are going to take. While preparation of the sales budget, we are going to consider analysis of sales previous year, salesman estimates, general trades conditions, availability of raw material, plant capacity, seasonal functions. So these all we are going to be considered. Next one is the production budget. Production budget talks about the production prepared by the production manager. It shows that forecast of output. The objectives to determine the quantity of the production budget period. The first dawn of the quantity, each product of quantity of the production translated into money terms. So how much we produced, what is the number of quantity we produced, what is the worth of the production we completed. So that all are we are going to be considered in the production budget. So these production budgets, they are going to cover some factors, that is time lag between the production sales and production considered. The stock of the goods maintained by both factors, both the sales, the level of production needed to meet the sales program. So this all aspect we are going to be considered. Next one is the production cost budget. So production cost budget show the estimation cost of the production during the specified period. So it means what? To produce certain units, to produce certain number of units, what is the cost incurred? What is the estimated cost? To meet the problem, to meet the demand of sales, what is the cost incurred for the producing units? So that talks about the production cost budget. So this is the next one is the raw material budget. So before producing, we require the raw material. If you have raw material, then only you are able to produce. If you doesn't have that raw material, you cannot you cannot continue the production also. So the raw material budget talks about the estimation of quantity, all the raw material components needed to the output demanded by the production budget. So what is the raw material we required? How much quantity is right now available? In future, what is the requirement, estimated raw material we are going to take? So that all the aspect we are going to prepare. So that is the production budget. Next one is the labor budget. Labor budget talks about the how many labors are required, labor estimation only. So budget represents the forecasting of labor requirement to meet the determining company during the budget period. So what is the labor required? How many labors are right now working? So what is the demand of production is there? According to that production, we are going to set up the labors. So these are the different types of budgets. And production overhead budgets. Production overheads talks about the selling and distribution budget, administration cost budget, and capital expenditure budget. So this, here, production overhead budgets only we have two, that is selling and distribution budget and administration cost budgets only. So selling and distribution budget talks about the what is the cost incurred to sell the particular product and what is the estimated budget to sell that to distribution of that. So that we are going to take. Administration means to organize that organization. What is the office cost are incurred? So that all are we are going to take. Next one is the capital expenditure budget. Capital expenditure budget deals with the items not directly related to the profit and loss account. Generally, that whatever amount we spend for the long-term assets. So that is called as a capital expenditure budget. This budget shows the estimated expenditure fixed assets such as a land, building, plant and machinery, etc. It is a long-term budget. The budget is prepared after taking into the consideration of available productivity capacities, probably the reconciliation of the existing assets and possible improvements of the production techniques. It is separate budget may be prepared for the different items fixed assets for the plant and machinery budgets. So this is the capital expenditure budget. Next one is the cash budget. Cash budget is it is budget which is estimate the anticipated receipts and payments of the cash. So in particular during the period, how much cash is receiving, how much cash is paying, what is your surplus balance, what is your surplus balance. So here this budget talks about the cash statements only, the receipts and payments of the cash. So that is called as a cash budget. So generally this budget we are going to take only cash related transactions only. Any credits are there, when it will be realized on cash, so that time only it is going to be recorded. So here this budget, cash budget, we divided into two parts, that is receivables and payments. Generally we have three components. First, balance brought down we have to take, then we have to write the receivables, then we have to write the payments. So whatever that difference amount is there after deduction of payments from the receivables, that is carry forward the balance for the next period. So this is the cash budget. Limitation of budget control. So it is difficult to achieve the budget targets. See, whatever we prepare, that is exactly we cannot talk. We cannot estimation also. And it is danger rigidity. Always that budget is not give the proper accurate results. And it is very expensive techniques. To maintaining of this all the budget, we require the manpower, we require the some other facilities. So it is very difficult. Compare with the normally, this is very expensive. Budget is only tool of the management, not for the suitable substitute of the management. It budget is the only tool. And next one is the zero based budget. Zero based budget means first this zero based budget introduced in the Texas Instruments in the United States. It is introduced by Peter Peer in the year of 1969. In the year of 1969. So zero-based budget means what? So zero-based budget, when we are estimating, where we are forecasting for the future, present year we are taking as a zero. So every time before estimation, we taking as a base year. So that is the call as a zero-based budgeting. Traditional budgeting and zero-based budgeting. What is the difference between traditional budgeting and zero-based budgeting? Traditional based budgeting, mainly it is past performance only we are going to prepare and actual cost only we are going to take. But zero cost budgeting is prepare the budget starting from the zero. So every year, every time we started fresh, every time it is taken as a base zero. So that is the difference between traditional budgeting and zero based budgeting. So this is the various types of budgets. Next one, standard costing. Standard costing means what? So standard costing is a predetermined cost, and this predetermined cost based on the technical of estimation estimates material, labor and overheads for the selected period of time. It is a prescribed set of working condition. So it is a predetermined cost. So standard costing is a technique which is complementary to the actual costing and historical costing. So here some various steps also going to be involved. So setting the standard cost, different elements like material, labor and overheads. The recording of actual cost, we are going to record the actual cost and we are going to compare the standard cost with the actual cost and the finding out the variances. We are going to find out the differences and analysis variance is known as a reason for them. So reporting the variances analysis, therefore the management appropriate the action for the necessary. This standard costing and what is the difference between standard costing and budgeting control? So standard costing, generally we are going to compare with the standard cost with the actual cost. But budget control is not like that. We are going to estimate for the based on the past. So these are the main advantages. These are main the differences. What is the advantages and limitations of the standard costing? It is the cost effective control. Generally, when you compare with the other techniques, this is the effective cost control. And it will, we are going to measure the performance measurement only. It is helping in the planning and it is delegation of authority and fixing the prices formulation policies and facilitate the coordination, cost constitution. So these all are the benefits of the standard costing. What is the limitation of standard costing? Fixation standards are very difficult and frequency revision is required. It is expensive techniques as budget technique. And it is not useful the non-standard products. Only standardized products only it is helpful. And segregation of variance is very difficult sometimes. And inefficiency staff incapable operations also very important. And preliminary for the establishment of the standard costing. First, we need to establish the cost centers. After that, we classification of accounts we required. The types of standard, basic standards, current standards. Again, that current standard, ideal standards, expected standard, and normal standards. Setting the standards. Here, generally, we are going to set up the standards direct material for setting of the standards only direct material and direct labor only. So material quantity we are going to use as material standard we are going to use material standard price we are going to use. Setting the standard direct wages, labor rate standard and labor time variance also we are going to consider. Competition of analysis variancy. See, variance is generally there are different variance analysis are there. Variance analysis is the process of analyzing the variance by subdividing of total variance and by the management assessing the responding for the in any of standard performance. It is the difference between standard cost and actual cost of the actual cost incurred during the period. So here first variant, then generally here we have four variances are there. First one is the material variancy, second one is the labor variancy, third one is the overhead variancy, fourth one is the sales variancy. Right. First one is the material variancy. The material variancy also we classified into different variances under the material variancy. First one is the material cost variancy. Second one is the material price variancy. Third one is the material usage variancy or quantity variancy. Fourth one is the material mix variancy. Fifth one is the material yield variance. Material cost variancy means what? The difference between standard cost of material and actual cost of material. So standard cost of material, how we are going to calculate that? Simply standard quantity into standard price minus actual quantity into actual price. So standard cost talks about the product of standard quantity into standard price and actual cost about actual quantity into actual price. The difference of standard cost and actual cost, that is called as a material cost variancy. Next one is the material price variancy. See, this material, the difference of standard cost material here, we are going to use material cost variancy, which is due to the difference between the standard cost and material used output. So here material price variance we are going to take the difference of the standard price and actual price. We are going to multiply with the actual whatever quantity we are using that. So that is called as a material price variance. Next one is the material usage variance. Material usage means the quantity of difference. The quantity of difference between the standard quantity and actual quantity. We are going to multiply with the actual price, standard price, sorry. So that is called as a material usage variance. So material mix variance. Material mix variance talks about the mix of revised standard quantity and actual quantity. We are going to multiply with the material price variance. So these are the formulas which we are going to use for the calculation of material price variance. So go through that. Next one is the labor variances. Labor variances again we classified into 6 categories. That is labor cost variance, labor cost variancy, labor rate variancy, efficiency variancy, idle time variancy, mixed variancy, yield variancy. Cost variancy means what? So as we discussed that material cost variancy, same similar to the labor cost variance also we are going to consider. Here standard hours we are going to consider and standard rate we are going to consider, and that standard cost, standard labor hours minus actual labor cost we are going to take. To calculation of that, standard hours into standard rate minus actual hours into actual rate. So next one is the labor rate variancy. The difference between the rate of the labor, we are going to multiply with the actual hours. So that is called as a labor rate of variancy. Next one is the labor efficiency or labor time variancy. See here, whatever the time taking by the labors, the difference only we are going to take. Standard hours minus actual hours, the difference of this, and we are going to multiply with the actual rate of the cost. So that is labor efficiency. Next, labor idle hour. Idle hour talks about the idle hours into standard rates. So whatever the wasting hour, that into rate, standard rate. Next one is the labor mix variancy. Labor mix variancy talks about the revised standard hours. So to calculate that revised standard hours of the grade divided by total standard hours into total actual hours. So that is only labor hours. So labor efficiency variancy and gang of composition variancy. So these all are the part of the labor variances. Next, overhead variancy. Overhead variancy talks about the first one is the overcost variancy. To calculate that overhead cost variancy, observed overhead we are going to take, actual overhead we are going to take. Or else standard hours for actual output and standard rate minus actual overheads we are going to take. Variable overhead rates. Variable overhead rates we are going to calculate standard hours for actual output into standard variable overhead minus actual variable overheads. So these are the overhead formulas are there. You can go through that. So this is the story about the standard variances. Sales variance also there is a formula is there. You can go through that. The next important chapter is the next important chapter is marginal costing and differential costing analysis. So marginal costing and differential costing analysis. Marginal costing means what? Marginal costing is a variable cost. So when the change of cost due to the change of output, that is called as a marginal costing. So marginal costing is different, marginal cost is different, differential cost is different. Differential cost talks about the difference of the two alternative of cost is called as a differential costing. Absorption costing means what? It is the total cost. It includes both fixed cost and variable cost, that is called as the absorption cost. Cost value profit analysis. Cost value profit analysis talks about the relationship between the cost and profit and sales. So this is called as a CVP analysis. So to analyze this cost value analysis, we need to find out the first contribution. Then we have to calculate the contribution break-even point. Then we have to calculate the margin of safety. So this is the CVP analysis. First one is the contribution. Contribution means what? The difference between sales and variable cost is called as a contribution. So the sales minus variable cost is a contribution. See, generally marginal costing, there is a equation. Sales minus variable cost equals to the sales minus variable cost is equal to contribution. That contribution includes the fixed cost as well as profit. And break even point. Second one is the PV ratio. PV ratio talks about the one of the most important ratios studying the profitability of operations. That PV ratio is nothing but a profit volume ratio. To calculate that PV ratio, we are going to take contribution by sales into 100. Next one is the break-even point. Break-even point is the level of sales where we are going to meet the fixed cost. So at the same time, this break-even point also we called as a there is no profit and there is no loss. So costs are equal to our revenues. So that is called as a break-even point. Margin of safety. Margin of safety is nothing but the difference between actual sales minus break-even sales. Above the break-even sales, we called as a margin of safety. So this is the standard costing. Marginal costing application. Generally, it is going to apply the product or sale of mix when you are producing the more than two or more products. So which product is giving the more profitable, which product is giving the less profit. So for that and closing down of the plant of the product. So when they want to sometimes the plants we are going to shut down. So before shutdown, that plant is covering the at least fixed cost or not. At least if you shut down that, at least minimum any cost is we are going to avoid or not. So that benefit we are going to check it that. And make or buy decisions. Before my make or buy decision talks about the, instead of preparing by yourself, if you purchase outside, so what is the cost you are going to be reduced? If you make or buy decision, it is purely depend on the your variable cost only. If the variable cost is if the buying cost is less than your variable cost, you can buy from outside. If your variable cost is, if your buying cost is more than your variable cost, you better to make it. So that is the method we are going to, we are going to use that. And next one is the differential costing. Differential costing is nothing but a, when there are two alternatives are there, if you use one alternative, what is the cost, and if you use second alternative, what is the cost. So compare with the two alternatives, what cost you are going to identify, that is called as a differential costing. So this is the for black for three topics, that is budget, budget control, and standard costing, and marginal costing. Go through that.